Well, good morning. This is July 28th, another Tuesday live webinar. Tave and I are in the studios here at West USA, and I want to thank them very, very much for allowing us to use this platform. It's a great day in Phoenix, Arizona, and we're going to be doing a presentation really on income. And of course, with this recession, people are probably very concerned about how do I get reliable income? How do I get conservative income? But it would be really nice to have some income at this juncture during this recession. We really find out how valuable having a complete source of income truly is. So we're going to be making this presentation available on YouTube. Tatum will be more than happy to provide a PDF for anybody that would like. And if you look on the right side of your screen, you're going to see a section that says for questions. You're more than welcome to answer a question. If we have time during this presentation, we'll be more than happy to answer any questions that pop up. I'm anticipating to be very, very conscious of your time, and we're going to try and make this about 20 minutes, and I think we'll be finishing up unless there's some questions coming in. So again, this is about income. And of course, we want to make sure it's conservative income because whatever capital that we have, we need to be very, very conscious of preserving it and being prudent with our money. So what we want to do is develop a machine, a money machine. And you know that that's one of the things that I'm so invested in. So we want to know where can we put our money that we can get reliable, consistent, and very, very conservative income. You know, particularly as you age, it starts to get to be a point where we can't get this money back. This money needs to last us the rest of our life, no matter how old we are. You know, if I'm 65, I could easily live to be 95, and with all the medical advances, we could go into 100. So that means that we need to use this money for 35 or 40 years. So we have to be very, very careful with it, and we have to be very cognizant of what we're doing with it. So there's some places that we can put this money that are very, very safe. Treasury bonds, U.S. Treasury bonds, probably the safest investment in the world. U.S. has never defaulted on any of its debt. It's the reserve currency. If you hold the bond until maturity, you're going to get your money back. So is safe? You bet. This is as risk-free as you can possibly get as long as you hold it to maturity. Reliable? Absolutely. You're going to get semi-annual payments consistently. Every 6 months, you're going to get a payment. Is it livable? Can we live on what we're going to earn from a U.S. Treasury bond? Absolutely not. No possible way can you live on this. U.S. Treasury bonds, you have to go out to 10 years to get 0.6% for the year. So you would be tying up your money for 10 years at 0.6%, less than 1%. So really, it's not livable at all. It would be something I would say, wow, who would want to go ahead and do that? You could park some money there if you just want to make sure that you get your money back, but you're not going to get any earnings. Certainly not something that you can live on. And here's the problem when you start going into bonds. Even with the U.S. Treasury bonds, you have interest rate risk. So when you're at historic lows on interest rates, that typically means that these interest rates are at historic lows. They're probably not going lower. And if they start going up, you have an inverse relationship with bonds. As interest rates go up, those that hold bonds, that bond starts to lose value. So if interest rates just went to 2%, it would significantly impact a U.S. Treasury bond if you wanted to sell it in the open market. Now, if you held it to maturity, you'll get your money back. But if something came along that you had to sell it instead of 10 years, you had to sell it 2 or 3 years, you're going to take interest rate risk and you won't get as much money as you put down for that money back. Now, how about banks? They're FDIC insured. Are they safe? You bet. They are really, really safe. Up to the limits, and I think it's $250,000 for an account, but you can have several accounts, so you can spread your money around. If you have $1 billion, that might be a problem, but for most of us, we don't have that kind of money. So we could easily do $1 million or $2 million. We could spread it around. Reliable? Absolutely. You'll get paid on these. that they pay their bills. I don't see the banks in any trouble. If they are, well, then you've got FDIC insured, but you'll have plenty of time to know that. Are they livable? Sorry, guys, they're in the same uh, bucket as the Treasury bonds. They're absolutely not livable. You can't live on these. They're even worse than the Treasury bonds because the savings and money market for rates for banks today, and it's July 28th, 2020, those rates are just barely over zero. And I mean, just barely. If you had a fee on the account, you wouldn't get any money. So it's 0.05. That's less than 1/10%. And if they're really generous, really, really generous, you get 15/100ths of 1%. So safe, yes, parking money is all you're really doing. If the bank charges any kind of fees, all the interest that you've earned is going to go away. Reliable, yes. Livable, absolutely, positively not. So no way you can live on this money. And of course, here we are in kind of an unusual term and time. We find ourselves in a recession where some businesses are deeply impacted, some aren't, but those that are, how nice would that be to have a check coming in each and every month that you know is coming, that you can live on, at least mitigate some of the problems that you're having, have a reliable platform, but it needs to give some money. So why don't we think of going to Wall Street? We're going to put our money with the big boys. We're going to get out there Wall Street and mix this money up. Well, what are our options doing that? Well, you can get into the S&P. And of course, that's the Standard and Poor's 500. It's the top 500 companies in the United States. These are pretty good companies. They're pretty reliable companies. They've been around for a long, long time. They do very good business. They're very, very well run. I mean, to have your money in the S&P is just a great thing. However, it's a little better than a savings account. Certainly better than some of the bonds with the government. But you're only going to get still less than 2%. 1.93% is what it's giving in July of 2020. Reliable? Yeah, you'll get paid on these. These are pretty good. Now, here's the problem. Dividends are paid from profits. So if companies are making money, that's part of the income stream. So when you're buying a stock, you are buying a future stream of income. And of course, if they're not making any money, they're not going to pay any dividends. And what has been happening in the last 4 or 5 months, we've just had this enormous, deep, deep recession. Now, some companies have continued to make money. Some companies make money but don't pay dividends, like Amazon. Amazon does really, really well, doesn't pay a dividend. So what happens if the S&P, instead of paying a dividend, they start keeping that money for the company because they only pay on profits. If they don't make a profit, they don't pay the dividend. And of course, what happens to the price of the stocks if we're in a situation like now when they're judged on how much money they're making? And if they're not making money, the price of the stock goes down. So there's some risk. And of course, you know about the volatility. We've had 1,000 points down, 2,000 points down, 1,000 points up. A lot of people having trouble sleeping at night with that kind of volatility. So maybe it's good for you. Maybe it's good for a portion of your money. But if you like to sleep well at night, like myself, I'm going to have problems with that. Now, here's another place that's been traditional is to go into corporate bonds. Now, they have a little more risk, but some of these, if you go into the investment grade bonds, they are pretty good. But an investment grade corporate effective yield, really from some of the best around, still about 1.5 points. So a lot better than going into the banks, putting in your savings accounts, putting into money markets. Certainly better than going into the U.S. Treasuries, taking a scotch more risk, but not a lot of risk, but still only about 1.5 to 1.75. And if you go up into the seasons, this BAA corporate, they're just one step above junk bonds, and those are in the 3%. So what about safety on something like this? Well, they're fairly safe, but you do take risk. Here again, we're looking at the possibility that business has really, really stumbled. Lots of things are not doing well, and a lot of our corporations are loaded with debt. So what's the possibility that we have defaults on companies that aren't doing as well as they did a couple years ago? the bondholders don't get paid, so you take that risk as well. You also take the risk of interest rates. So not only corporate credit default, but if rates start going up at all, because again, these are historic rates, then what happens is that both the bond value will drop unless you hold it to maturity. If you hold it to maturity, again, you're fine. So maybe if you take a 2 or 3 years, but keep in mind, you're still the shorter the maturity, you're still only getting 1.5 to 2%. Not livable and lots of risk. So you have to talk to your advisor and say, is the return I'm getting on this yield worth the risk I'm running? So maybe for a portion of your portfolio, but you really have to be careful with what you have. And of course, global debt, people have been going into sovereign debt. And of course, around the world, debt has just exploded. So we have trillions and trillions and trillions of dollars of debt. We have about $85 trillion more debt than what we had in 2009 when everybody said they'd never do this again. They've added another $85 trillion. And just last year, 2019, not a bad year, they added $10 trillion in sovereign debt. So if you ask your advisor what kind of risk that you're running, it would be very prudent. To me, I think this kind of debt that's around the world is unsustainable. And of course, governments and municipalities, they run into they have the same problems that you and I do running a household. If you don't have revenue coming in, you can't pay your bills. And of course, sales tax, when restaurants and retails are closed down, there's no sales tax coming in. Same when people aren't driving, they don't get any tax from road tax. So they're going to be running problems. And of course, they have lots of debt. So you may want to talk to your advisor and say, how much risk am I running? And find out what is prudent for you. And we just want to talk a little bit about what's going on in the economy. I've been talking about the fact that we saw that the economy popped right up, started recovering, but we have seen right here a plateau. Now, this is from the Economic Cycle Research Institute's public index. You can get that on their website. It's certainly available to you. And this section right here has started to plateau, which means that things are not continuing going up. This was that manufacturing and industrials that popped right up. But keep in mind, we're a service economy. A lot of our service is slower than it normally is. Some of them are still locked down. And of course, we're plateauing. So if we look at another leg, I'm using just another, I promise I've only got a few of these charts in here. But if we look at another leg, we start to see right over here that we're starting to get a downturn. And if that downturn, we could, instead of getting a V recovery, remember we talked that there was two possibilities. We're either going to get a V recovery or a W recovery. This looks like we might be getting a W recovery, which case it might be just a little longer. And we just got this, I just got this basically yesterday. And it tells us that business isn't quite as good as it is. And this is just confirming that things are starting to slow down and turn over, in which case we may very well go into a distorted W recovery, which would slow things down just a little bit. It also fits into my timing model very well if you want to talk to me about that. So this is kind of what it looks like we're looking at. We're looking at like a distorted W, so we might slow down a little bit. We are going to recover, so it just might be same time frame, just a different trajectory. But we might get a little opportunity to buy some properties here if this thing slows down. But it will then pop up. But it probably looks like we're going to have a W. So where can we go to put our capital? Because we love getting income. Don't you just love going to the mailbox and finding a check in there and say, this is just great? That's called mailbox money. We love that. Where do you go? Where do you go where there's demand? Because when there's demand, real organic demand, that's where you have the economy is doing really well. So we're looking for some place that's got rising home prices and rising rent, because that's the other place we can go, is go into residential rentals that pay a lot more income to us, like double or triple or quadruple what we can get elsewhere. So we got a real livable income for ourselves. And How about the added bonus of having prices going up? So not only do we get income and we get that check each and every month that we can live on, now we're going to get some prices that are heading up. It's called appreciation, and that's where demand is. Where is it? It's in Arizona. We're getting over 200 people every single day want to come move here to Arizona. A lot of them are Californians. Californians are looking at our housing. They look at a $400,000 house and say, wow, that's an $800,000 house in California. I can buy it for half price. And they're coming here and buying our properties left and right, and they're driving prices up. They're exiting California. We also have a huge, enormous influx coming in from Illinois that has just accelerated recently. We're seeing a lot of people they're struggling a little bit getting rid of their properties in Illinois, and they're coming here to Arizona. Phoenix, of course, getting a huge amount of them, but we're seeing people going to Tucson, going to Prescott, they're going to Kingman, they're going up into the White Mountains. So a huge influx of people. Right here in Phoenix, we're getting about 220 people net every single day moving here. It's over 100,000 people a year coming here. So is that demand? Absolutely. Is it organic demand? Absolutely. And we've talked about the trends. We have lots and lots of trends coming here. So we really have a very good market that we get both income and appreciation. It's a wonderful thing. So we've talked about the trends. Here's another one that we're seeing. We're seeing capital coming from overseas. Capital flight is moving here to the States. Everybody wants to get into where the safe dollar is. They want to get into the reserve currency, and they want to earn US dollars. So we're seeing people from Canada. We're seeing people from Europe. We're getting people from Asia. And of course, from South America and Mexico are bringing money into the United States, and they are putting it into real estate. A lot of the Asian economies, real estate is really the best place that they have, and they know real estate. We're seeing lots and lots of money coming here. So the capital flight is positive. Demographics, of course, baby boomers like me are getting older, and as we start to see this recession, a lot of them are deciding to go ahead and retire. Maybe they're retiring in their 60s. Maybe they're taking whenever they can. But as soon as you retire, you're done with the cold. You're moving to somewhere south, and that, of course, would be Florida, Texas, and Arizona. So demographics are positive. Cycles are positive. This is talking about maybe we're going to get this. We're probably right about here. We might get this little bit of double dip, which we've talked about. This is going to be a terrific buying opportunity for all my investors. Right through here, this is when we're going to start going into the accumulation phase, and we're going to want to start buying these. And of course, the migration trends are absolutely extremely strong. We've talked about the fact that coming from Illinois, we have a lot of people coming from Texas, and of course, California is just flooding over into Arizona. So you can get reliable income from real estate? Absolutely, positively. We get the average tenant here is occupying for 4 years. Is it a livable rate? Absolutely, it's a livable rate. And you know what else? We keep increasing the rent. So not only is it livable today, it's going to be more livable next year. Let's just think if you had 10 properties, and we have gone up so far this year, almost 7% on our rent. If the average rent is $1,500 and it goes up 7%, that's over $100 a month. Times 12 months, you're getting over $1,000. It's almost $1,200. What if you had 10 of these? You'd be getting $12,000 extra this year for income. How's that for growth? And of course, what if it did next year? You get another $12,000. I'm going to tell you this trend has been going on for 4 or 5 years. Our income has just exploded, and it's paid every single month. We have great property managers that will keep at least, they'll take care of all the problems for you. You can park your money. You can call us from Switzerland. You can call us from Spain. You can call us from Singapore, and we'd be more than happy to be involved with you. But this is just an absolutely terrific place for you to put your money. So just think, we had Tina Tambor on last week. We were talking about how fast Phoenix is appreciating. We are looking at capital appreciation. Prices of homes have gone up between 9 and 12.5% this year alone. So if you had to put 20% down on a property in January and it's gone up 10%, You put $20,000 down on a $100,000 house and it goes up $10,000. That capital that you put down earned 50% in 7 months. 50% in 7 months. And this is a trend that is going to last a decade. We have all the trappings at the fact that Maricopa County may become the new Orange County where everybody wants to come here. We just don't have the housing to accommodate everybody. And that is called organic demand, and it's going to drive our prices up. So the median rental has driven up 6.9%. We've talked about that. This has been going on for years. What if you did this for every 3, 5, or 10 years? So not only becomes livable, but you could see your rent almost double in 5 to 10 years. And so not only would you be getting a very livable, but you'd be getting an organic increase in your rental rates as well. And here's the one thing that we love the most. You know, when you buy real estate and you park it here with one of our property managers, you own it. It's yours. It's titled in your name, your LLC, whatever trust that you want. You can give it to your kids. You can sell it. You can trade it. You can do anything you want. You make the decision. It is absolutely positively yours. You decide how much debt you want to put on it. You decide what market segment that you want to do. It is yours. We're here to guide you. We'll help you in every way we can, but it is yours. You don't have to talk to a fund manager in Wall Street and ask him what's going on, because you know it belongs to you. It belongs to your family. You can will it. It's just really, really good for you. This can go on for decades. So let me just recap. Stocks yield less than 2%. And that's recent. If we start looking at what's going to happen in the next 3 or 4 months, if the economy still continues down, like we're looking at this W recovery, that 2% may go away because there may not be any earnings. And of course, we have seen the volatility in stocks. So do they have risk? It's pretty doggone high. Treasury bonds, virtually no risk at all if you hold them to maturity. Probably the safest investment you can possibly have. But you're parking your money for 10 years to earn less than 1%. Maybe you want to park it for 2 or 3 years and earn absolutely nothing. It's like 0.15%, just incredibly low money. Good place to leave it. You know, maybe it's part of your portfolio. Maybe it's part of your strategy to do this. You want to talk to your investment advisor to find out what's good for you. But I'm going to tell you, if you take a real long-term bond and interest rates go against you, you're going to be very, very guarded. You could wake up in the morning and find out that your corporate bond has lost 10 or 15 or 20%. And of course, if it's one of those industries that are struggling and had default, you could lose more than 10 or 15%. So there's a lot of risk in the bonds, a lot of risk in the stocks. So what we want you to do is get a money machine for life. And of course, you can do that with real estate. You'll have a money machine. Each and every month, you're going to get yourself a check come in the mail to you. You can call your property manager, ask what's going on. It is yours. It belongs to no one but you. You get both yield that you can live on and grow. Each and every year is going to get more and more and more, so that your lifestyle is not only maintained, but enhanced. And we've enjoyed this great appreciation in these organically growth markets. So we're here in Phoenix. We'd love to be involved with you. If we can help you in any way, please let us know. If you want us to guide us, we are just more than happy. We'd love to have your business. If you have any questions, if you have some concerns, we're here in the corporate offices. This is Michael. You're welcome. You're welcome to call us. If you have a 1031 exchange, we've had an awful lot of people calling us from out of state that want to sell their properties in Illinois or Texas on a 1031, and they want to replace it here in Arizona. We're more than happy to help you with that. Just let us know at Creating Wealth at West USA. Same with if you want a complimentary consultation, just let me know. Typically, it goes for an hour. We'll sit down, find out what's best for you, find out what your goals are, where you want to be in 5 years from now. You know, at West USA, we're more than happy. That's part of my function, is to sit with you and see what we can do to get you wealthy. West USA wants you to not only do well with your business, they want you to create a sustaining income and wealth for you and your family. If you want to diversify your cash flowing investments, just let us know. Talk to your financial advisor. Find out what your income needs might be for your portfolio. If you need to add some real estate to it, we're more than happy to help with that. You're welcome to contact us again at Creating Wealth at West USA. And if you're just getting started and you want some guidance, we're more than happy to do that. We have several strategies to help you with. We have a investment program coming up, and we're going to have a real estate investment advisor class starting reasonably soon. If you're a real estate agent looking to upgrade your business or just become a little more informed, and you're always welcome to call me here at West USA at 602-942-4200. I office out of the Kierland. And again, I want to thank West USA for this platform. They're here for you guys. So next week, we're going to be talking about the accumulation phase, which we're going to be entering very, very soon. Don't miss that. We've got a podcast on Saturday. Don't miss that as well. My very best to you. If you need me, give me a call. We're very good at what we do. Bye-bye now.